where is the smart money actually going? Look, if you want aggressive wealth creation, you really need to know where to look. So let's jump straight into the research and find out. So think about large caps for a second. You've got these massive giants like Hull, giving you a slow, steady 5 to 6% volume growth. But then you have the small caps. This is a massive playground of over 800 stocks. The source material makes this brilliant comparison to cricket. Investing in small caps is literally like stepping outside the crease, waiting for that one perfect full toss and just smashing it for a six. All right, let's get right into section 1, small caps kajadu. Here is the golden rule of this entire playbook. 3 to 4 years. That's it. You only deploy your hard-earned money into a stock if you have absolute high conviction that it's going to double in that specific 3 to 4 year time frame. If you don't have that confidence, you just don't invest. It's all about demanding absolute returns, not just slightly beating a benchmark. Now, you might be wondering, in a universe of 800 stocks, how do we actually find the ones that'll double? Well, based on the data, you have to hunt for extremities across 3 main pillars. You're looking for great management, a great business model, or great valuation. A winning stock needs at least one of these pillars to be exceptionally strong. That is your key to finding that outsized growth. But hey, does every single stock you pick need to be a massive winner? Absolutely not. Investing is not about being perfect, right? Even if you have a strike rate of just 6 out of 10 winners, meaning 4 out of 10 are complete misses, you can still pull in massive high-teen returns for your overall portfolio. It's super reassuring to see that even the veterans rely on this kind of diversified, Peter Lynch-style approach. Here's the catch, though. This kind of aggressive strategy requires serious discipline. And by discipline, I mean sitting on cash. If you can't find those perfect full tosses we talked about, you just quietly hold on to your money. In fact, this Veterans Fund did exactly that last year when they hit 16% cash reserves, simply because the right opportunities weren't there. Moving on to section 2, kahan banega paisa? Where will the money actually be made? Let's look at the actual hunting ground. According to the research, there are 3 main sectors primed for exponential growth as India's economy structurally shifts over this next decade. First up, pharma, which is being driven by a massive healthcare transition. Second is manufacturing, simply because of the urgent national imperative to create jobs. And third, insurance, which is rapidly turning into a massive consolidation play. To really understand this, we need to look at a fascinating macro trend from the source material called the 100 rupee shift. Basically, as per capita income crosses a certain threshold in India, that extra 100 rupees you earn doesn't go toward buying more basic staples anymore. Instead, it aggressively shifts toward healthcare, diagnostics, and wellness. It's a huge structural change. And then you have insurance, which is basically a textbook consolidation play. Here's how it works. First, way too much capital floods into the market. Because of that, the industry's return on equity completely drops. Then, the weaker players can't get funded anymore, so they exit. And finally, the remaining leader sees their profits absolutely surge. We literally saw this exact same cycle play out historically in the telecom sector, and general insurance looks like it's next in line. But wait, before you go all in on manufacturing, listen to this stark warning from the veteran. You should not pay more than a 20 to 25 PE for manufacturing. It needs working capital. The big takeaway here, yes, India desperately needs manufacturing jobs, but it's a very capital-heavy business. So paying sky-high, exorbitant valuations just because a theme is popular right now, that is a very dangerous game. This brings us to Section 3, Global Market AI Risk. We have to zoom out for a second and ask the tough question, Kya AI ek bubble hai? Is artificial intelligence actually a massive bubble? It's fascinating because historically, the real return of U.S. markets always reverts to around 6.7% above inflation. But right now, they're sitting at nearly 13%. That is a historic red flag that overvaluation might be peaking. Just look at the numbers. Tech giants are currently pouring a mind-boggling $1 trillion annually into AI capital expenditure. Think about that. But here's the reality check. Cheap, open-source AI models are suddenly coming out of nowhere and threatening those massive investments. It's creating a scenario where future monetization is going to be a huge, looming struggle for big tech. So, what does this all mean for us? Well, if this AI bubble actually bursts, global tech funds are going to panic. They'll desperately rotate their money out of tech to protect their capital. And in that specific scenario, defensive plays like Indian IT services and financials act as a vital safe haven. Sometimes, boring, defensive stocks are exactly what you need to protect your wealth when the high flyers crash.
Now for our final part, Section 4, Investing का सही Mindset.
Let's shift away from the hard numbers for a minute and talk psychology. You have to be aware of the unknown unknowns. Guys, no matter how flawless your fundamental research is, random events are going to hit your portfolio. Period. Think about it. COVID was an outdoor risk, not a balance sheet risk. When these unpredictable shocks happen, your mental stability is literally your ultimate weapon. So how do you actually survive 30 years in the market? You adopt the veteran mindset. First, always maintain a solid 3-year horizon. Second, stay completely detached from those scary monthly drops. Third, whatever you do, don't get rigid in your views. And finally, treat life and the markets with a sense of randomness. Embracing the Zen-like psychology is exactly what keeps you sane and in the game for the long haul. And this doesn't just apply to stocks. Check out this mind-blowing quote from the source about our careers in this new era. You can't do a job just as a job anymore. AI will do that. You need massive passion. As we move forward, standard, routine jobs are going to be completely cannibalized by AI. True burning passion is going to be your only real edge. So, as we wrap up this explainer, I want to leave you with one provocative question to think about. Are you investing your money and your time with passion and detachment, or are you just blindly following the herd? Really take a moment to think about that. Thanks for tuning in, and we'll catch you next time.